From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 13th, and you're listening to the HPS Insight Macrocast. I'm Tony Fratto from Hamilton Place Strategies. Sitting in New York today, John Fagan and Brendan Walsh from Markets Policy Partners are in the studio in Washington, D.C. Guys, if you're superstitious, this is our very first Friday the 13th Macrocast. So, anything can happen today. We had some things happening this week, some significant ECB news. We had some hope on the China front. Maybe some return to some green shoots, some hope that at least things will get pointed in the right directions. Equities did lots of activity in equity markets. Credit markets, we've seen some rebound in sovereigns, but ECB was the big news this week. This is Mario Draghi's penultimate meeting. Brendan, what was the last big move of Mario Draghi?
Yeah, so the market was expecting a cut and also them to reignite their quantitative easing asset purchases. But in the kind of the week and a half kind of leading up to it, we had a little hawkish statements from some of the ECB board members. So the market, I think, was a little jittery going into it. But in the end, Draghi was able to get his votes, and they decided to cut the deposit rate by 10 basis points. So now it is negative 0.5%. They also are going to purchase $20 billion, or 20 billion euros, of European both corporate and sovereign debt per month. This will start in November 1st. And then also at the press conference, Draghi kind of put the pressure on the elected officials to, he's delivering on the monetary stimulus that maybe some of the countries, notably Germany, can pick up their fiscal stimulus.
Yeah, and that appeal to fiscal stimulus was echoed by some other board members this morning, and even by the European Commission Vice President as well. So there's obviously we've seen this in the context of Germany as well. Some unsourced German officials talking about a growing appetite in Berlin for perhaps loosening their very tight fiscal purse strings. But it's very incremental. Some of the other stuff that came out of the ECB decision was the deposit rate has been weighing on banks, and bank CEOs and management have been complaining about this. Deutsche Bank's management complained about it most recently. And so the European Central Bank introduced a tiering concept. So part of the bank's excess liquidity that they park with the European Central Bank will not be subject to negative rates. So that's been helpful for the banks, although Draghi, there was a little bit of a sting in the tail there when at the press conference, there was a question to him about the impact on banks. And he said that European banks have a lot bigger things to worry about than negative interest rates.
Right.
Ouch, their bloated cost structure and so forth, and bizarre balance sheet holdings. So it was there was a parting shot there from Mario Draghi in his last press conference.
Obviously, he's right. He's right. European banks do have a lot of work to do, in particular German banks. So he's definitely has a point there. You're right. So it was expected. Somehow markets expected more, but there's some in the markets expected more, which I thought was really that surprised me because it doesn't have a whole lot of room to go.
There's a really interesting dynamic in the market. Typically, when all else being equal, if a central bank eases policy, that will weaken the currency and bring down sovereign yields. And what we saw yesterday was that in the lead up, as Brendan mentioned, there was a sense that maybe the European Central Bank was getting cold feet about doing really muscular easing. So we saw German yields on German bonds heading higher into the meeting, and we saw the euro rallying into the meeting, and there was a sense that perhaps the markets were anticipating a disappointment, something a little less accommodative. And then the European Central Bank delivered basically, not just the rate cut was in line with expectations, but the quantitative easing, it may have been a smaller monthly number, but it was open-ended, and they basically left it open until they'd achieved an interest rate goal. Now, there are some issues with that. They have, they have particular quotas that they may run into, and some analysts have pointed that out. But an open-ended QE program is, potentially could lead to some very big numbers of asset purchases. And so this wasn't, it's hard to say that this was and although some analysts are making the case that this was something of a disappointment in terms of the degree of easing that they put in, certainly the Euro Stoxx index, the European equities didn't seem to feel that way. They rallied. U.S. equities were rallying too. The euro initially fell on the announcement, as did yields, and then the euro bounced, as did German yields. But peripheral, which are more sensitive to European Central Bank policy easing, the peripherals rallied relative to the Germans. So it was a very risk-on response. And there's analysts are kind of debating as to why is the euro rising? Why are German Bund yields up again this morning? And it's just the various things they're throwing out are maybe people really believe that this easing by the European Central Bank will be reflationary and will help growth. Maybe all of the talk about fiscal, getting more fiscal firepower in the EU is getting some traction. Or maybe it's just the fact that behind, in the background was some really positive news in the U.S.-China front. So maybe that was just driving it, and we're
right. I mean,
misattributing the signals.
Yeah, I mean, that's definitely contributing to good feelings everywhere. If and certainly should for Germany, the EU's largest economy, a thaw in that relationship, if it is pointing in the right direction, and we're going to see. I don't think anyone should expect resolution anytime soon, but if there's a small agreement that has them having serious discussions, we've said here for a number of weeks that the market would really welcome that, and of course here we are poised today for potential record highs on Dow and S&P today. That's not that's possible. So a lot of good feelings about that. Even if I don't want to spend too much time going into what the president misunderstanding what the ECB is trying to do. He seems not to understand that the European economy is experiencing some a lot of drag right now, and Draghi's trying to use whatever tools he can to try to return them on a path to growth. The president seems to think that they're trying to trick us, and we can target currencies. Actually, Draghi addressed that very directly. By the way, also he was asked about currency values, and he said, as he said many times in the past, very clearly, they do not target currency values. They don't target exchange rate values. So I thought he handled that really well. I think I'd take a minute just to actually look back on Draghi a little bit, because this has been one of the more historic tenures for a central bank governor anywhere, through really challenging times. And you can make a case that he is, in the top 3 or 4 most successful central bankers ever, through really, really difficult times. Everyone would like to remember whatever, it'll be on his tombstone probably, whatever it takes, right?
His signature line.
His signature line to save the euro, and signal to the world that he was going to save the euro.
And I don't know, in the last 5-6 years, Europe's kind of been quiet. We haven't had any worries about the end of the world. But I think people forget what it was like in 2012. I remember I was at a hedge fund and following it very closely, and we were really worried about the periphery defaulting. And then Draghi gives this speech. I remember it was early U.S. time, and he started it by talking about a bumblebee, and he said he was talking about the euro, and a bumblebee shouldn't fly, but it does. So the speech kind of began a little weird and was confusing.
He might have had a few glasses of wine before the speech.
Yeah, I remember this. The speech was in London. It was July of 2012. Yeah, and it was a colorful speech.
Yeah, and then he says, within our mandate, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough. And then,
was that ad-libbed? And believe me, that will be enough.
It has to be. Yeah.
Yeah. When I remember watching the video and thinking that part was not. Yeah. And believe me, it's a lot. It sounded like he kind of looked up and said it. And yeah.
Because then I remember spending the next 6 hours on the phone with anybody I could talk to who was a somewhat of an expert on this. And do you believe it? Can he do it? Does he have the votes? And a few people were skeptical, but by the end of the day, the market had accepted that Draghi has taken over control, and then he added super to his name.
It didn't. Go ahead, John. Yeah, exactly.
I went to look at. I had forgotten the date of the whatever it takes speech, but it's not hard to find if you go back and look at a chart of Italian or Spanish or Portuguese bond yields, and you're basically the absolute. That was the turning point. It was the date of that speech.
Yeah.
He turned a market cataclysm around, and
we were buying Irish debt that was yielding close to 10% at that time, and now it's what, 1%?
Yeah, and this wasn't. So he took the post in November 2011. I believe that wasn't even. That's not even a year later. I mean, he was a rookie.
So very early. He didn't have a long track record it's astonishing that the market had that much confidence in him, given the short time he'd been there.
Right. The things that he had done prior to that, obviously reversing some of the ill-timed rate hikes that the European Central Bank had done in early 2011. Reversing those, and then coming up with the, I believe it was the TLTR, a long-term refinancing. Basically, it's concessionary loans to EU banks to shore them up, to help shore up their functionalities. That was something that he did relatively early on in his tenure as well. So he was already rookie of the year.
No, totally.
Yeah, exactly.
And that's another thing that people forget. We were worried about European banks, big banks, going under. The same, with TARP in the United States, that really put a floor on the U.S. Banking sector. Draghi was very creative and was able to push this through, and it really it gave people safety to keep their deposits.
And he did it in an environment where the traditional European Central Bank philosophy was very conservative. It's at the heart of the European Central Bank is the Bundesbank, and the Bundesbank's entire philosophy was shaped by that German hyperinflation. There are lots of theories about why the Bundesbank is why it is, but it has a their
hyperinflation,
right.
No.
Economic historians, economic historians believe that shaped the ethos.
Well, if you think about, Mario Draghi being the right man at the right time, and he did have actually, while he was a rookie as the central bank governor, he had a lengthy experience as an academic economist, as a market economist, as a regulator, as
the Bank of Italy,
central banker at the Bank of Italy. And so he really at the World. He spent time at the World Bank, so he understood, challenges for emerging economies. Also, so very experienced person. I mean, we used to meet with him, when he was at the Bank of Italy, and just a really impressive person. So he did come in with knowledge and experience, and the people who knew him had a lot of faith in him. But it's important to remember he was he was not the first choice to be ECB governor at that time. If you go into that period of 2011, the presumption was that the Germans were finally going to get an ECB governor. It had been the Frenchman Jean-Claude Trichet, which, by the way, you mentioned, Trichet's, who's a wonderful, lovely person, right, but made two of the worst monetary policy decisions probably in history, right? The 2008 rate increase, July, ECB rate increase, into the face of a financial crisis. And then again, in his last year, the rate increases were ill-timed. Just not a clear view of what the world is. But a lot of that pressure came from the Bundesbank. Axel Weber was supposed to be he was the presumed central bank governor, and it's interesting game to think about what Europe would have been with an Axel Weber central bank governor, with the challenges that we saw in the Draghi era, especially with Greece and the pigs.
Yeah, trying to gaze into that parallel universe is it's hard to imagine that certainly the policy, that a policy response to the European debt crisis would have been as swift and as effective at the very least. I think that one could make that claim with relatively high conviction. But also looking back, it's not just Draghi was able to perform monetary miracles in the face of stiff resistance from the Northern European / Bundesbank. He dragged them so far and into negative interest rates, QE stuff that was just an anathema to them. Years ago, he just wore them down, and he's obviously a deft political operator. He also had to light touch. He made it look easy, and he went into press conference after press conference over the years with very lofty expectations. And it's really hard to think of a Mario Draghi press conference, even when expectations were very baked into the cake for him to do some easing, for that easing to be a disappointment or fall flat.
I agree.
He was such a master of the craft. But also from the perspective of foreign investors, and maybe this looks different if you're sitting in Europe, but from the perspective of foreign investors, he was an atlas upon which he carried almost single-handedly the European project forward. Now, there are plenty of people that think that would say it's not worth saving, or he's maybe delayed the inevitable, or the Euro skeptics among us. But it's hard to deny that when there were enormous forces that were potentially pulling the EU apart, he was almost Churchillian in standing against those. And he was a real leader. He was a European leader.
Truly. I mean, look, we could, a bunch of nerds on podcasts talking about macroeconomics, talking he's the Tom Brady, of central bank governors. But you're right. It was Herculean in given the task that he had, the challenges he had. By the way, QE, which he just announced very easily yesterday. Can't forget, when he first started talking about QE, it wasn't clear that it was legal, and in fact, he had court challenges to be able to go ahead and continue executing it. So look, we'll have more to say. I think
the fact that he had market experience really helped him. So he was always very aware of what the market was expecting. And not that he always had to deliver what the market wanted, but also I think that knowledge helped him sometimes in negotiations, where maybe at a press conference or two he would disappoint the market a little bit to put some pressure on and get his votes, so that at the next meeting he was able to do. And also I think he was very creative in the financial products that he helped create that helped stave the crisis.
Let's come back and talk about markets. It's a good time. We got to get a break in. So why don't we do that right now? We will come back. I think when the handover comes with Draghi and Lagarde, come back to this. But let's take a break here. You're listening to the Macrocast.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
Okay, we're back on the Macrocast. We saw definitely some activity in equities this week. John, how are you reading it?
Well, the S&P 500 is now, it's basically right back to its all-time highs that were registered in late July. This is a pretty sharp snapback that we've had. It's after a rocky August. And this week we saw really on the surface of the index, it looks very pleasant, very placid. The S&P closed flat on Monday and Tuesday and then moved upward. But underneath the surface, the hydraulics underneath the surface are very, very different. There's a what they call a big rotation going on, rotation among sectors, a rotation among.
Could you explain that?
Yeah, it's a rotation among investment styles. So we've seen this counter trend. Well, basically since last week, we've seen this counter trend move in Treasury yields and core EU bond yields, which we talked about before. Basically, these yields are rising. The 10-year Treasury was below 1.5%. It's now at 1.8% as of this morning, and the euro is bouncing. And these counter trend moves in currencies and sovereign bonds are being mirrored in some counter trend moves in equities. The very popular trade this year has been for momentum stocks or growth stocks. This is kind of the tech, semiconductor, these endogenous growth stories where you don't have to rely so much on global growth. It's a growing business in and of itself. And this, what they call this growth kind of factor, has been a really popular trade at the expense of value. Value tend to be your value stocks, tend to be your traditional economy stocks, industrials, materials, also banks. Mm-hmm. And this week, although the index has been going up, underneath the surface, value stocks have been dramatically outperforming growth stocks. And so if you're a hedge fund and you're long growth stocks, betting on upside for growth stocks, and short value stocks, betting on, i.e. betting on downside in value stocks, and then their performance profiles completely reverse, you're losing money on both sides of that trade, and you've got magnified losses. And we've heard lots
a lot of active equity managers basically lost about half of their performance this year.
We've heard
when you look on the TV, it looks like it was a kind of a boring, quiet week, but everybody in Wall Street is absolutely freaking out.
Yeah, howls of pain from the leveraged community on Wall Street, because everything encapsulating the counter trend rally in simple, plain language is everything that used to work ain't working now. And I'm getting carried out.
That's why it's a market.
Yep.
Yeah. Saw some crazy action in oil this week too.
Yeah, it was the announcement. We had an OPEC committee meeting, and so oil prices had been rising into that. There was a sense that they were going to discuss more production cuts, and then something happened in the middle of the week. John Bolton had an unexpected or hasty exit from the National Security Council, and then on the day of the OPEC meeting, the headlines appeared that morning that President Trump was exploring much more robust diplomatic channels to try to solve the U.S.-Iran standoff, and putting the potential rollback of sanctions on the table. Oil prices didn't necessarily have a huge geopolitical risk premium in them, but they had something, because those headlines smacked oil prices lower. The prospect of a cooling U.S.-Iran tensions really obviously knocked prices lower, and then OPEC couldn't come out of their meeting with really supportive language, and oil prices are continuing back lower today.
It's really, I have to say, I've been following, geopolitical events and economic events for, I don't know, 30 plus years, and I've never seen anything like that, where an NSC director has impact in a market like that. So we've seen them come and we've seen them go. Never seen anything like that, where just the breaking news, the headline that Bolton was resigned / fired, would have that much impact in a market. That was clearly unprecedented.
Yeah, the really bearish fundamentals in the oil market, the reports coming out from industry analysts about the degree of oversupply, even without assuming that Iranian supply goes back to post-sanction levels, that would really increase the glut. It's under pressure for sure.
Yeah. Well, good fun. All right, let's take our last break now, and we'll come back. You're listening to the Macrocast. I'm Tony Fratto from Hamilton Place Strategies, John Fagan and Brendan Walsh from Markets Policy Partners in Washington, D.C.
This year, HPS is celebrating its 10th anniversary. Since HPS was founded in 2009, nearly 200 talented employees have contributed to all that we are today. Be sure to check out HPS Insight on Twitter and use the hashtag HPS10 for more on the anniversary.
Okay, we're back on the Macrocast. So looking ahead to next week, look, the big news next week is FOMC. Markets are, clearly going to be looking for the committee to follow through on, expectations for easing. Brendan, what are you seeing?
Yep. So at the last meeting, they lowered it a quarter point, 25 basis points. So now the federal funds rate is at 2% to 2.25%. The market is very much expecting another quarter, 25 basis, a quarter point lowering. The Chairman Powell has really, in his last couple of speeches, kind of calmed the markets and basically guaranteed it. So the drama won't be over whether they do it or not. It'll be kind of the future messaging, whether we're going to get any more. And then the other kind of big event of the week is coming out of China. So we have on Monday night, Sunday night into Monday morning, we have China industrial production and also retail sales and their fixed asset investment. So it's kind of a unique glimpse into the health of the Chinese economy. So that'll be a big night.
Yeah, there are pretty big things on the calendar. There's also a pretty big thing on the calendar for HPS, isn't there, Tony?
There is, actually. So, Hamilton Place Strategies 10-year anniversary. We'll be celebrating next week. It's hard to believe it's been 10 years. It's been incredible fun growing the business and seeing it expand. So terrific. We've been able to be involved in a lot of the really big, both U.S. and international economic issues, and representing really amazing clients and amazing, HPS team members, which we're looking forward to see. A lot of them are going to come back and visit. So it's an exciting time for us. You get to see it. You're in our offices all the time.
It's been amazing.
Indeed, yeah.
But I also remember 10 years ago that we were kind of talking about maybe a global depression at that point. So what was going through your mind? You're coming out of government and you decide to be an entrepreneur and start a company. I'm kind of fascinated.
It's funny
how it came about.
I would go around and talk to people because I'd never started a business before. And I'd go around and talk to people about, starting, I had this idea for the business, this idea if we could bring together, communicators and people with issue and policy depth and the ability to do deep analysis, evidence-based communications. And they also thought, well, that's a really great idea. But they say, Tony, there's a recession. I was like, yeah, right. Kind of familiar with that. I'll tell you, like, a couple of things. There are a couple of lessons that you learn. One is that you kind of have, when you see the hole, you have to run through it, right? You don't get especially when you get to a certain age like me. You don't have a whole lot of chances. And I had terrific job offers out there that I knew I could go do, and those were probably the safe. Those were the safe decisions. But I had this idea for the company, and and so one thing I knew was I probably wasn't going to get that opportunity again. To be coming out. My reputation was good coming out of Treasury in the White House, and I had a really good network, and I thought that was a good opportunity. So you go out and take advantage of it. The second is that you find out in a recession. Is like the paradox is that the availability of talent is really rich. It's like sure. I felt like Forrest Gump after the storm. Like I had the only boat, and right. I mean, everyone else was like right. Going out of the business, leaving, and there were all these really amazing people who I probably had no business hiring and no business bringing into a brand new firm, but they didn't have a whole lot of options out there because hiring was tight. So I was able to just over the next few years be able to really attract really wonderful people, and that's at the end of the day that's the difference for us. If you could get really high quality people who could do all of the things that we're trying to do. People who listen to this podcast, they see and hear Matt McDonald a lot, but our whole team has been really wonderful. like Matt, I probably had no business, hiring, having Matt's a founding partner of the firm, but I had no business, getting someone like Matt McDonald.
And it's times like that, and when like 2009, when uncertainty is so high, and the ability to add value in an environment like that is just, if you're able to do it right, as you and your partners did, then the follow-on gains from that are really they're so incredible and be compounded and set yourselves up for success as the economy rises. It's the right time. It's the right time to spend money on analysis and rethink when you're at those turning points.
Well, it definitely feels good. We're in New York now, and I've spent a lot of time in New York building the New York office, and we have a presence in Silicon Valley as well. And so it's 10 years. I'm knocking on wood here. We're thinking about the next 10 years now, which you don't usually have an opportunity to plan for. And so we're thinking about that. But it's great to spend it with you guys. We've got the podcast start. I didn't think it would take us 10 years to actually get the podcast going, but we have our podcast going now with great friends like you. So big week next week, and we'll have a lot. Maybe we'll have some things to talk about next week on that too.
Great, congratulations to you, Tony, and congratulations to the whole team at HBS, present and past, and everybody that's contributed to this really incredible group that you've got here.
Really appreciate it. Thanks, guys. And we'll be back with you next Friday on the Macrocast. Have a wonderful weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.